Good morning. Today is March 15, 2017, and that means it's Fed Day. We will be getting the rate announcement later today at 2 p.m. Eastern Time, and we'll also be getting the Fed forecast as well as a press conference. So joining me today is Keith Bliss of Cuttone & Company. Keith, great to have you here today.
Thank you, Remy. Always good to be with you.
Well, we had a slew of economic data this morning, and there are jitters overseas ahead of the Dutch elections. But here in the U.S., we'll be watching the Fed. Now, a rate hike is baked into the cake, so we'll be paying attention to the language coming out from the FOMC. So what terms will you be watching out for?
Right, you're absolutely right. We're going to get 25 basis points. That was my call even a month ago when you really started listening to listening to the Fed speak and parsing apart their words. They were pretty clear that they were going to move in March, and as I started saying, beware the Ides of March, which is what today is. But I don't think the market will take it too badly, as you say, and correctly so. It is baked into the cake. We're expecting this 25 basis point increase. The market is responding properly to it and taking it in a positive light, because it is a signal that the U.S. economy is healthy and continues to gain strength. So the most important thing today is not going to necessarily be the rate hike. Again, it's anticipated, but what is going to be the language that comes out of the Fed statement in the aftermath? Will they even be more hawkish? They had told us that there's going to be 3 in 2017. This will be the first. What is going to be the timing and pace for the other 2, if there are only 2? Or will they look to move for a 4th one in 2017?
And Keith, as you mentioned, it's also about the number of rate hikes that we'll get out of the Fed this year. If you're reading some of the financial headlines out from the media, you're starting to see the term stealth rate hikes. So That's very interesting. But in this environment, how do you suggest investors should weigh sectors or fundamentals as well as technicals?
Well, I think what they should do is what we've been saying all along, really since the election, and you've seen it take off. The financial sector is still probably the best bet for money in 2017, just because of the confluence of fundamental factors that are impacting the financials, not only the Fed on a pace to increase short-term interest rates, which will impact the yield curve across the entire term structure, but then the regulatory environment in the reduction of regulations, which will absolutely come out of the Trump White House, has already started to come out, will continue at pretty good speed throughout 2017. And if there's some sort of tax reform, the one caveat to that, though, is there was a report this morning that lending is actually back to 2014 levels. Some of that is fundamental in structure and structural issues with borrowers who were kind of waiting for the election results, so they didn't do a lot of borrowing, and they've not gotten back into the game as well. But when it comes to technicals right now, the thing that does worry me about the market is we've seen the small caps break down. The larger cap indexes are still holding steady above some really long-term trend lines and support levels. The small caps have broken down right now, and generally in the proxy I use, there's the Russell 2000. Generally, when the Russell 2000 starts to move down, it leads the rest of the market. It's slow to catch up when there's a move up.
Well, Keith, you mentioned a lot there in terms of fundamentals as well as technicals, and indeed yesterday we saw the Russell 2000 dip into negative territory for the first for this year.
Right.
But as we head into the rest of the week, we only have 2 more sessions, but we have a lot on tap. We do have the Trump administration announcing their budget for next year. We have the elections overseas, and we have Merkel and Trump meeting on Friday ahead of the G20. But we also can't ignore what we're seeing in the commodity sector, including gold breaking below 1,200 today, and of course oil prices. Now, what do you think we should pay attention to?
Well, I've long said that I would stay away from the commodity sector for the foreseeable future, just because I don't think you're going to get a lot of long-term trend movement inside of any of those commodities, whether it's oil, gold, some of the other silvers, the dirty commodities as well, and primarily because there's still a lot of interpretation as well as uncertainty around still monetary policy, global monetary policy, tax policy here in the U.S., which will impact the dollar and the yield curve. And of course, oil has its own fundamental play, but a lot depends upon where the dollar moves as well. So I think oil is oversold right now for sure. It's starting to make a comeback, and it should trade higher, but it's never going to get out of that $50 to $60 range for both Brent or WTI. And I think gold is locked into the same sort of range. So if I were putting money to work on a short-term basis, I don't think that I would be touching the commodity space this year. And that also means the companies that play into that commodity space, whether there's basic materials or the energy complex. I just think there's better uses for your money for 2017.
Okay, Keith, well, a lot to digest this morning, so thank you
Indeed.
for joining me, and have a good day.
Thanks, my pleasure.